Welcome to this edition of Kuvera Insights. My name is Neelabh, and as always, we talk to industry participants and bring their insights to you. Today, we discuss index funds, a subject and a product category that we at Kuvera have always been very passionate about. By virtue of their simplicity and universal suitability, index funds find a lot of mention in Kuvera's discourse throughout our journey, whether through blogs or through the Kuvera application, etc. For this conversation today, we are joined by Chintan Haria from ICICI Prudential Asset Management Company. By way of a quick background, Chintan heads Principal Investment Strategy at ICICI Prudential AMC and has been with them since October 2005. That's almost 20 years. At iPro, he has worked in various verticals in the asset management space, including dealing, research, portfolio management, and product development. This experience has been across multiple product sectors. By qualification, he has an MCom from Sydenham College in Mumbai and is a qualified CA, CWA, CFA, MFA, and a CMA. For those who don't know, we will provide details of these abbreviations in the description. A very warm welcome to you, Chintan, and thank you so much for taking time out today.
Thanks a lot, Neelabh, and always a pleasure to connect with all your listeners, viewers, and wishing them a great 2024.
Thank you very much. So let's straight away jump into our set of questions. We'll try to keep it as crisp as possible. Starting with Chintan, can you help us understand what is an index fund and how does it work?
We are seeing, and we are talking at a time where probably in December we've crossed 50 lakh crore as AUM in mutual funds. So the understanding is much higher of investors today relative to what it was 5-6 years back. And thanks to you and your efforts, probably more investors are going to get into deeper knowledge on the index funds. Now, if we look at a large part of the AUMs which mutual funds run, it is on the active mutual fund side, which is active equity, active hybrid, active debt. However, in the last 6 to 7 years, especially in the last 2-3 years, passive funds have picked up a lot in terms of understanding investments, more so with high net worth individuals, do-it-yourself individuals who are trying to invest in markets. And the understanding globally as well as in India of passives is increasing. And in the passive funds, there are index funds and ETFs. The topic of discussion today is index funds. ETFs we can discuss separately, but index funds, if we look at it, are very simplistically mutual funds where the underlying benchmark is replicated in the fund itself, and the number of stocks, the names of the stocks, and the weightages are in the same proportion as that of the benchmark index. So in some sense, index funds are a way of allowing investors to participate in the benchmark index itself in the same weights, same names, and same proportion as that of the benchmark index. There is no active fund manager who's deciding which stock, which sector, which weight. It's just the replication of the underlying index, and it is becoming more and more popular as a category. And there are various options which are available within index funds in India.
So, Chintan, how does this work? So, there is an index, let's say the BSE Sensex or the Nifty NSE. So there will be a fund which will invest in exactly the same stocks that the index and in the same proportion as is reflected in the index on any particular day. Is that the right way to understand this?
So let's look at the two options that you said, Nifty 50, which is the most popular, and Sensex 30, which is the most popular and historical index that India knows. So if you look at Nifty and Sensex per se, you may want to invest in those barometers or benchmarks in India to participate in India's growth. Nifty 50 is top 50 names in India, generally Sensex 30 is 30 names. And it is a way, index funds provide you a platform or a way of easily participating in Nifty and Sensex, because all what an index fund would do, let's say a Nifty index fund would have the 50 stocks of the benchmark Nifty index and in the same weightages and proportion which the Nifty benchmark index would have. So the index fund gives a replication it tries to replicate the underlying benchmark index. And that is an easy way for investors to participate in the index fund, be it through lump sum or SIP. It's just an easy way to participate. Likewise, in Sensex, if there are 30 companies, the 30 companies with their weights would be replicated in the Sensex index fund. So if you're investing in a Sensex index fund, you're technically investing in those 30 companies in the weightage proportion which is there in the Sensex index. So index funds provide the investors an easy way to participate in whatever benchmark index they choose. And they can do an SIP or a lump sum, and it becomes a convenient way to participate in a index fund for those who are probably looking at getting market or market linked returns.
Right, right. So in a sense, and like you also mentioned, index funds therefore are passive in nature. We are there's no fund manager uh, decision making or involved in the selection or the weights of the respective stocks. Since that is predetermined, therefore they are passive in nature. Um, how do they? How do these funds? So let's say there's a Nifty. Let's take Nifty fund for an example. There's a Nifty fund, and how would such a Nifty fund compare to an active fund which also invests in the same um, basket of stocks? Maybe not exactly the same, maybe not in the same proportion, but it invests in the same basket of stocks. How do they compare? And if you can help us understand uh, in general index funds versus active funds by taking a specific index. You could pick up any index. I just said in Nifty as an example.
So let's look at the large cap universe in India. There are large cap active funds which are called blue chip funds or large cap funds, and there the fund manager has the universe of 100 stocks. And those 100 stocks, within those 100 stocks, the fund manager would curate a portfolio of, let's say, 25 to 30 stocks typically, wherein the fund manager would have certain differential weightages. The fund manager may have a positive view on banking. They may go overweight on banking. The fund manager may have a negative view on FMCG. The fund manager will keep FMCG to zero, and so on and so forth. And they do it actively on a day-to-day basis or a monthly basis in terms of whatever they feel is good. And within the sectors also, then there are certain stocks which provide different times, different entry points, and then they become expensive, and then that churn also happens. So an active fund manager, be it stocks or sectors, keeps churning within the universe of top 100, which is the allocated universe for, say, large cap universe. Compared to that active fund on the large cap universe, a passive, let's say Nifty 100 index fund or a Nifty 50 index fund is a fund or an index fund where passively, without any involvement of an active fund manager, the 50 names which are there in the benchmark Nifty index, where let's say roughly 30% is banking, 11% is IT, about 15-16% is oil and gas, around that much. That composition of 50 stocks in that weightage is replicated without removing any names, without bringing in any new names, without changing any allocations or percentages compared to the benchmark index. So effectively, an active fund manager, by making the changes in the portfolio construct, is trying to beat the underlying benchmark index which is compared to. And in the case of index funds, that particular benchmark index itself is getting replicated. So in the context of the market, if you're looking at market returns or market beta, the index funds become handy to the investors. While if the investors want a return which is, let's say, more but can be less also, because active funds can deliver alpha as well as probably underperform the benchmark indices, that's where the active fund management part comes in. So if you compare both, active fund managers try to beat the benchmark. In trying to beat the benchmark, sometimes you may underperform for a certain period of time also. So there is a moment of underperformance, overperformance over benchmark in the case of active funds. While in the case of index funds, there is no overperformance or underperformance. The objective is to replicate the underlying benchmark index, and so your returns are also going to be similar to what the benchmark index is given, subject to the tracking errors and the expense ratios.
Right, right. Um, so the way you described it, the product itself does not sound very complicated, right? I don't have to, as a investor, I don't have to apply too much of my mind or time in doing the selection of a particular portfolio if I'm going to replicate the index, let's say, right? Neither as to the proportion. Um, can I, as an investor, not just try and do this at home? Um, with some basic trading skills and probably some data from the exchanges, I could be maybe I'll be able to do this myself.
So there are two parts to it. One part is that the index data itself is provided by the index managers and you have to subscribe to it. So there is a cost to that. Second is when you're trying to do it yourself in terms of even execution, the minimum basket size, which let's say will allow you to replicate the entire index in its proper weights, etc., ranges between 50 lakhs to 1 crore sometimes. So if you have that kind of money, yes, you will be able to execute, but then you'll not be able to churn that easily. You'll not be able to move out and move in. So theoretically, it is possible that you will be able to buy and sell and do it. But then if you buy and sell and do it, there are transaction costs, impact costs. All your time will go in trying to replicate it on a day-to-day basis. You'll have to keep a watch on the dividends which come. You'll have to keep a watch on reinvestments, which corporate actions are happening. All that is generally taken care of by the asset management company and the professional dealing desk that they have. If you do it as an individual, it obviously adds a layer of complication that you'll have to follow all of these. If you have the time, you can, but then there are costs plus the taxation element also comes into picture because every time you buy and sell, you'll be liable to pay tax. So there's another additional layer of work that you'll have to do. While in the case of an index fund, the moment you're investing in an index fund, you will stay invested without any taxation element coming into picture. And as and when you redeem or as and when you take out the money from the index fund, depending on whether it's been less than 12 months, more than 12 months, you'll be liable to tax on the gains that you make, or to that extent, it is easier for you to manage that part. So theoretically possible for you to replicate, but it is not as easy as it sounds because of the nuances that exist in running a benchmark oriented index fund.
Right. I'll just summarize it. It's probably far more efficient to do this by way of investing into an index fund rather than by on all parameters, whether it is cost, whether it is the time required to execute the necessary strategy, uh, or even in terms of the taxation itself. On all of these parameters, it turns out that investing in an index fund is a far better strategy. Of course, if you are, I'm just comparing index fund uh, and versus replicating it at home, where there is no discretion involved in stock selection. Uh, so yeah, thanks for helping us understand that. Now, in terms of you mentioned in your previous response about the cost, and um, while it is generally understood that the cost is lower, how are the costs low, and in what sort of comparing it with active funds, to what magnitude can the is the delta in terms of cost?
So it's a very interesting question because expense ratios form a very important element of the decision making that investors have. In the case of active funds, because there's an active fund manager involved, not just the active fund manager, there is a team of research analysts which is covering all the sectors. So it's a much wider apparatus required. The costs are to that extent higher than that of passive funds. In the case of passive index funds, the only cost that is there predominantly is the index subscription cost and the dealing apparatus which is required for execution. So the other costs are much smaller on account of, let's say, the processing charges, operations, etc., much smaller. So if you compare active and passive index funds, active funds are obviously a little bit more expensive. But then as investors, the choice which you have is that do not make an investment only on the basis of cost, but choose the product which suits your overall allocations well. Active and passive both work in different time horizons at different points of time. In fact, this is a very common question which I'm asked these days, thanks to the knowledge which people have about active and passive, and should I not invest in only passive because active fund managers are not performing well. That's the mindset which has probably been created with some articles which are there around. I'd say that in India, since we are a growing economy, active fund managers also have a scope to outperform, and which they have been. If you look at the last 2 years, predominantly a large part of active fund managers on the large cap side have been outperforming. And on the mid and small cap side, you may say, okay, indices are doing so well, active fund managers are not able to do well. Active fund managers are probably trying to manage the risk as well, because when the markets go up in a bullish territory in mid and small cap, not the weaker balance sheets or the weaker stocks also go up sharply. And then when the market turns, they come down. So you get the benefit when you're invested in an index in the small and mid cap. And you obviously get hurt also because there's no risk management being taken by the active fund manager. So don't only make the choice on the basis of cost. However, yes, index funds are cheaper because of the fact that there's no active fund manager involved. And they are meant to be cheap ways globally as well as in India of participating in a benchmark index, while active funds are to that extent slightly more expensive because there is active fund management costs, which are there over and above the normal costs which are there in any fund.
Right. So, you made a very relevant point about not gauging an index fund purely on the basis of cost or the expense ratio. Uh, to be fair, when you compare an active fund's return versus a passive fund's return, they're already net of cost. So, in that sense, the cost data is already included in it, and therefore it shouldn't be used as a benchmark. To that extent, you're absolutely spot on. Uh, and to the other point that you made, just wanted to understand about this risk management aspect of it. Let's say the index that a fund is tracking. Let's say the index is not doing that well, maybe because of a particular segment, particular industry. Say let's say banking. Okay, can the fund manager move investments out of that uh, of a in an index fund scenario? Can a fund manager move their investment away from that particular industry, that segment, and move it to cash, or let's say invest it into a different stocks? Is that possible?
The question in some sense is probably also going to answer the question that what are the negatives that are there in the case of index funds, or if I'm doing passive fund investing, what are the potential negatives that I get when I'm investing in the passive funds? So the way I look at it is, for example, in 1999 or in 2008, in 1999, software became a very large part of our index. In 2008, the real estate sector, the capital goods sector became a very large part and more expensive. And then there was a sharp correction in those segments which had gone up very sharply. And when the sharp correction happens, unlike in an active fund where the fund manager can choose to stay away from an expensive tech sector in 1999 or an expensive real estate sector in 2007, in the case of an index fund, there is no fund manager in terms of active fund management. The fund manager's job is to ensure whatever is in the index will get replicated in the index fund as well. So the benchmark and the index fund portfolio will be the same, irrespective of whether there are expensive names, cheaper names, higher allocation to a particular sector which is very expensive. There is no active involvement in the case of index funds. So to your question that if banking is not looking that good and if the index fund manager feels can he remove it, the answer is no. The index fund manager has to track the index, and the tracking of the index means all the stocks in the same proportion as that of the underlying benchmark. And so that also becomes a negative at times when if there are certain set of stocks which become so expensive and their weight in the index becomes so large that when there is a subsequent correction, even if I as a fund manager know that they have become expensive, I will not be able to remove them till such time as the index gets rebalanced by the index provider. And that happens only when these stocks will go out of the top 100 names. So they have to fall a lot before they go out of the top 100 names. And by that time, the damage is done for the investors. So that is probably the only negative that I see, that in index funds, if the market is turning from being very expensive in certain stocks, you don't have a choice of not having those stocks as part of your investment. But if you have a longer term horizon, these things tend to even them out, and you will ultimately get the benefit of the growth of the country, especially in the large cap indices.
Right. So, Very interesting insight here that it's an additional risk that you mentioned, that when there is a downside, concentrated downside across certain sectors, you can't move away from those, and probably the only option available to an investor at such a time is to completely move out of the market, or completely withdraw from whatever they have invested in that index fund. uh, though such occasions will be very few and far between, because generally trends are more secular, and that is the whole purpose of the index creation by itself, right? um, so that's so does that mean, and I'm just trying to sort of understand, does that mean that any kind of investor, or is there a particular kind of investor for whom index funds are suitable for, or what kind of weight should it carry in a typical asset allocation? And you don't necessarily have to give percentages, but you can just explain by way of a conceptual, that let's say, I have equity allocation in my portfolio of my asset allocation should be, let's say, 80% and 20%. In such a scenario, what should I consider as an ideal asset allocation for index funds, or passives versus active?
So, in terms of who is the investor for which index funds are suitable, index funds are suitable for every investor, large, small, first timer, seasoned investor. There's no doubt that index funds are available, and there are sectoral index funds, there are thematic index funds, there are large cap index funds, mid cap index funds, small cap index funds. So the variety is there and it suits all kinds of investors. There's no specific investor category as such which is only suitable as far as index funds are concerned. And as far as asset allocation is concerned, through the experience of last many years of speaking to people and seeing the portfolios, what I have understood is that the first part is extremely important, which is having a certain base portfolio in the balance advantage fund or the multi-asset category. After you created a strong base, you build it with active funds like flexi cap fund, value, special situations, mid cap, small cap. That is your choice depending on your risk. And once you have created the active bouquet as part of your equity portfolio can be 75%. The balance 25% you can participate in the market through the index funds or the ETFs or the passive fund route. So I would say that because there are times where active does well, because there are times when passive does well, you need to have both. And the percentages, as I see it, 75% in active, 25% in passive is good to start with. It is not a formula which will work for everyone, but most people can start with this and then you can fine tune it according to your own risk profile. But the important aspect is keep as a strong base a sizable portion of your allocation to the balance advantage fund category or the multi-asset category. And then after that, you build the entire structure based on your comfort. You could have, let's say, only large cap index fund, you could have mid and small cap index fund, that you choose basis what is your comfort. Or you can say, okay, I'm very confident of banking in India, so I'll have banking index fund only. I'm very confident I want tech because tech has underperformed. Then you can add IT index fund if you wish to. There's healthcare index fund. So the choices are yours, what you want to participate in through the active and passive route. But the options are available. Just that you create your asset allocation in a seemingly well-balanced manner so that whatever is the market ups and downs that will happen, you will not panic, you will not worry. And ultimately, in the long run, this bouquet will be a healthy bouquet for you to participate in a sensible manner and create wealth along with growth of India in the Indian equity markets.
Right, right. So, Chintan, I just wanted to bring in an insight of our own, from our experience, in relation to index funds and in relation to investing in mutual funds in general. Investors, when they are starting out small. When they start investing, whether by virtue of my salary is X amount, so I can only invest this much amount, or this is an experimental investment. I've never invested in mutual funds before. It's a new category for me. Uh, so to that extent, to um, index as a concept becomes very easy for an investor to understand because you're straight away buying the market. You're straight away, you don't have to really, with all of the messaging around different categories of active funds, different categories of index funds, you can, um, the long and short of it is that index funds seem to be a great entry product also for investors. For example, one of the entry products in the mutual fund space for a lot of investors used to be, I think continues to be ELSS schemes. They are exposed to mutual funds by virtue of the ELSS product and the tax saving that it brings. I don't know how that will play out over the long term with the new tax regime and all of that, but yeah, that remains. So by virtue of that simplicity, perhaps index funds will, index fund can be a great entry product as well. Having said that, I mean, that's something from our experience and our conversation with investors who come on our platform. Um, Now, let's say we've sort of zeroed down that yes, we want to look at index funds, include that as part of our portfolio. Um, we've even zeroed down on the segment on which we want exposure to an index fund. So let's say large cap. And again, going back to the example that we started with, let's say I want to invest in a Nifty index fund. Now, um, it would be a fallacy to compare returns of the index fund and choose the one which has given me the highest return, or use the one which has given highest return in the past, right? Um, could you just help us understand the nuance of this, and also how does one choose an index fund amongst the various options available? What should be the, what are the metrics on which one can compare index funds offered by different fund houses of the same, in the same segment?
Sure. So if you look at the first part as to how should I compare mutual funds, index funds, first thing is compare within a category of the same index fund. So if you're comparing, let's say, our index fund, which is say ICICI index fund in the large cap category, then compare, let's say, a peer group index fund, which is in the large cap category. So compare in the similar category. And when you're comparing in the similar category, you will obviously get a comparative return analysis. All you need to see is what is the expense ratio. The lower the expense ratio, it is better. Second is what is the tracking error. Tracking error is a technical term which simply is actually telling you that on a day-to-day basis, how has the fund returns been compared to the returns of the underlying benchmark. So naturally, if the returns are closer to the underlying benchmark, it means that the underlying portfolio of the index fund is similar, is closest to the underlying benchmark which is there, which means that the fund manager is doing a good job of replicating the portfolio in line with the benchmark. So the tracking error is effectively trying to tell you that the lower the tracking error, the better the index fund manager is doing the job of tracking the underlying index. So one is lower the cost or lower the expense ratio, the better. Lower the tracking error, the better. And of course, in terms of then the basic hygiene checks, whether you are comfortable investing with that asset management company, how long history has been, etc. That is your choice. But generally, you look at the expense ratio and tracking error. These two are an important element. And if you're comparing between different categories of index funds, large cap, mid cap, small cap, IT, banking, etc., don't make the mistake of just saying, okay, on the last 1 year, what is the best performing? And I will go with, say, small cap today would be the best performing. So I will be in small cap today. Maybe 3 years back, technology or IT index fund was the best performing. I'll be in index. What happens is every year or 2 years, these top performing keep changing. So don't go by past returns because that can lead to trouble as far as your investment is concerned. Stick to a more steady asset allocation based on your risk profile. An advisor or the platform can help you do that. That, okay, I want a certain allocation to large cap. I choose this index fund. I want a certain allocation to mid cap, I choose a certain allocation to small cap, I choose. And then if you want to be an active investor, you can basically keep moving between large, mid, and small. That's your choice. But do not make the mistake of selecting an index fund purely because it's been the best performer in the last 1 year. Because there are categories like small cap or IT or banking, which have different cycles, and in different cycles, sometimes they perform very well, sometimes they'll do badly. Like in 2018, I think small cap index came down by 29%. Again, in 2020, it came down. But in 2021, it went up very sharply. And again, 2023, it has gone up by 50%. In 2018, it came down 29%. In 2017, small cap index had gone up 60%. So if you invest when it has done well, you may end up having a negative experience also. Nothing can be sure, but these are cyclical. So be careful that you don't look at the rearview mirror and try to ride your investments, because it can hurt you in the long run. Have a more steadier asset allocation and stick with that. You should be fine in the long run, but don't chase returns. Is the simple mantra which all of the investors should keep written somewhere. Do not chase returns. Thank you.
All right, Chintan, thanks for that. You sort of summarized our entire discussion today as well. So I won't go into repeating some of those points. But fundamentally, index funds remain, and it's a growing category. It's heartening to see the way this category and the segment it has seen flows from investors, both retail, including from retail investors, and also the number of the number of schemes that are coming in. So in terms of options, investors have a larger, many more segments to look at from a passive category perspective. Um, so that's that for today. Thank you so much, Chintan, for your time. Um, as this goes live on the Kuvera Insights goes live, if there are any questions from investors, we would definitely reach out to you and uh, get inputs and get feedback from you. Um, Thank you so much once again, and it was great speaking with you.
As always, and look forward to another session soon uh, on a topic which probably investors would tell you that they want more information on. Thank you so much. And again, a happy 2024 to all your viewers. Thank you.
Thanks, intern. Bye. Have a nice day.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.